Hello everyone. We have already completed 30 questions in our last three parts. Now coming back to the fourth part. Here, as these are the revision lectures, we'll see whatever is given in the question and we'll make sure how to present the answer in the exam. Important points will stress, and this revision will be comprehensive revision which will help us the day before exam. So here, starting with question number 31st, that is VT Limited. VT Limited is entering into a contract with a customer. Okay, VT Limited is entering into a contract with a customer to sell the equipment. Now here, VT Limited is selling a equipment to the customer. Control will be transferred when the contract is signed, and the price is 1 crore in the contract, and this 1 crore plus 10%. Here, 1 crore, and this 10% is a contractual rate of interest. Okay, that is, if you take the customer is paying 60 monthly installments to the VT Limited, and one installment is 2,12,470, right? So if you calculate 2,12,470 multiplied by 60 installments, you'll get 1 crore 27 lakhs, right? You'll get 1 crore 27 lakhs 48,200. And if you discount this using the PV factor of 10%, okay, using the PV factor of 10% for 60 installments, you will get 1 lakh. So you can say this 10% is a contractual rate of interest. So we have to determine the discount rate. In first case, contractual discount rate. If the contractual discount rate is reflecting a rate in a separate financing agreement, if it is reflecting a rate in a separate financing agreement, here for that, for evaluating what is a discount rate in the contract, what is a discount rate in the contract, first, um, the this contract is having a significant financing component, we can say. Why? Because the cash selling price is 1 crore and he is paying more than 1 crore. Okay, that is 2,12,470 into 60 installments. So you can say that it is having a significant financing component. Here VT Limited observes that the 10% contract rate of interest reflects the rate that would be used in the separate financing agreement. This 10% is a separate financing agreement, contractual rate of interest between the entity and its customer. From the very beginning, this 10% is there. You can say this 10% as a contractual rate of interest, which reflects the credit characteristics of the customer and the market terms of the financing mean. So here, the market terms of the financing mean that here the cash selling price, whatever the cash selling price is, that is 1 crore. Okay, this is the amount that is recognized as the revenue and the loan receivable, and as a loan receivable when the control of the equipment transferred to the customer. We will write 1 crore as a loan receivable, and the remaining amount that is received will be the interest rate. Okay, like 2,12,470 multiplied by 60 monthly installments, that is 1 crore 27 lakh 48,200. If you could calculate this multiplied by 60 monthly installments, minus if you this into 60 monthly installment by using the 10% contractual rate of interest, if you get it that to a present value factor, you will get 1 lakh. You'll get 1 crore. Sorry, you'll get 1 crore. So you can say that the entity accounts for the receivable. Here, receivable will be 1 crore only. Okay. See, loan receivable will be 1 crore only. The remaining amount will be interest. Next, case B is if the contractual rate is not 10%. It is not reflecting the rate in the separate financing transaction. But here the contract rate is 14%, not 10%. So here in evaluating the discount rate in the second condition, while evaluating the discount rate, okay, that contains a significant financing component. Here you can say yes, even this has a significant financing component, but the rate is not 10%, but the rate is 14%. Here interest will be more, and our cash selling price will be less than 1 crore, right? Because our interest component is more, that is 14%. So how to calculate this? You have to just take to 14% divided by 12 months, you'll get an interest rate. Okay, 1 divided by that 1 plus that interest rate, that you have to discount for 60, means you have to take the installment, like you have to take 2,12,470 installment, and you have to get that to a PV factor as you have done before. 2,12,470, you have done the PV, you have took a PV factor, and you have got 1 crore. In the same way, if you take 14% interest rate, okay, that 14% is per annum, right? And here it is 60 monthly installment. That's why you have to divide this 14% by 12, and then you will get the amount, like this transaction price. If you discount it with 14%. See, what you have to write in exam is, in evaluating the discount rate, as it is not 10% contractual rate of interest, it is not contractual rate of interest, but it is lower than 10%, that is 14%. Okay, that is 14% rate of interest. That would be a separate financing transaction between the entity and the customer at the contract inception. Here you can say that the contractual rate of interest of 10% does not reflect the credit characteristics of the customer, and this suggests the cash 10%. Here 14%. In the second case, 14% is reflecting the cash credit characteristics. So you can say that the cash selling price is less than 1 crore. Okay, because the interest component is more. Here, VT Limited determines the transaction price by adjusting the promised amount of consideration to reflect the contractual payments using 14% interest rate that reflects the credit characteristics of the customer, and consequently, the entity also determines that the transaction price will be 60. Means you have to discount 2,12,470, and you have to discount it with 60 monthly installments at a rate of 14%. And this 14% is per annum. Like that, you'll get 91 lakhs 31,346. So here the entity recognizes the revenue and the loan receivable for that amount only. For what? Before, when 10% is the contractual rate of interest, it recognized 1 crore as a loan receivable and the revenue. But here it is recognizing 191 lakh 31,346 as revenue and loan receivable, and remaining will be recognized as an interest whenever the installment is received from the customer. Right? Clear? Now 32nd question. 32nd question is ST Limited. ST Limited is entering into a contract with the customer again. Okay. Here control will be transferred in 2 years. Here it is at a point in time, that is there in before question the control is transferred when the contract is signed, but here in 2 years, after 2 years it will be transferred. So here the customer in 2 years, the customer includes two alternative payment options. The first option is you can pay 5,000 in 2 years. 5,000 in 2 years when the customer obtains the control, that is in 2 years at a point in time. Or you can pay 4,000 now itself when the contract is signed. And what the customer did, it is beneficial for me to pay 4,000 now itself. So he paid 4,000 now itself. So ST Limited concludes that it contains a significant component because of the length of the time that is between when the customer pays for the asset and when the entity transfers the asset. So there is a significant financing component. Here the period between when the asset is transferred and contract is signed is 2 years. You going forward we'll read about the practical expedient. So this is if here, as the time gap is more than 1 year, practical expedient is not applicable. Okay, till here we'll learn, and when the practical expedient concept will learn, we'll go into detail. So here ST Limited is concluding that the contract contains a significant financing component because the length between them is more. So what you'll do here also, what the question says is interest implicit rate in the contract is 11.8%. So this 11.8%, whatever the interest implicit rate is there, okay, whatever the interest implicit rate is there, which is this is necessary, which is the interest rate that is necessary to make the two alternative payment options, which is economically equivalent. So it makes the two alternative options equivalent. Like if you take 4,000 and plus 2 years, if you take 11.8% for 2 years, you'll get 5,000. It's like it is making economically equivalent time value for money. It's an implicit rate. But here, what the rate is adjusted, the entity determines that the rate that is to be used for the promised concession of 4,000 is only 6%. That is adjusted by the entity. That is the incremental borrowing rate. So see, we have two rates: interest implicit rate, that is which will be economically equivalent, and next incremental borrowing rate is determined by the entity. So here pass the journal entries showing how the entity should account for the significant financing component. So first, journal entry showing the accounting for the significant financing component. First, recognize a contractual liability for 4,000. First, you have to recognize a contractual liability, that is your liability. First, you have to recognize liability, then the amount will be received, right? First, whenever the why you are recognizing a contract liability? Because after 2 years, you're supposed to deliver the asset. to the customer, but the cash is received now only. So you have an obligation. So cash to contract liability 4,000. And next, after 2 years, whenever you are transferring the asset to the customer, you have to adjust with 6% rate, because this is the incremental borrowing rate. 6% is incremental borrowing rate. So what you'll do, 4,000 plus 6% plus 6%. You'll do for 2 years. Okay, 6% plus 6% is this interest on interest. Then you'll get 4494 minus 4,000. So here interest component is interest expense to the contract liability. So interest expense to the contract liability, and that will be 494. So interest expense is also recognized as a liability now. Whenever the asset is transferred to the customer, then you will reverse the liability and we will recognize the revenue. Next question, 33rd question is, ABC Limited is entering into a contract. This as per for everything you have to write as per Ind AS 115, that is revenue from contract with customers. We have to write. Next, ABC Limited enters into the contract with the customer of power plant that includes the scheduled milestone payments. Again, here power plant person is paying ABC limit for the performances that is made. He is paying a scheduled milestone payments, and here throughout the contract term he is paying. But here the performance obligation will be satisfied over time, and this milestone payments also will coincide with the expected performance of ABC Limited. So as and when the service is transferred, as and when the contract is done, customer will pay the milestone payments. But here, the contract provides a significant percentage of milestone payment would be withheld as a retention money. So here, retention money is something which is intended to protect the customer from the contractor failing to adequately complete his obligations. You can say this retention money is a safeguard for the customer. This is a protection for the customer. Okay. So here, what he is saying is whether the contract, what he is asking us, whether the contract contains a financial component or not, financing component or not. This is a question. So here you can say no, this doesn't have a financial component, because why the retention is done? It is to protect the customer. So answer goes like this: ABC Limited concludes that the contract does not include a significant financing component. Why? Because since the milestone payments coincide with the performance, and the contract requires the amounts to be retained for the reasons other than the provision of finance. Here, the withholding of a specified percentage of each milestone payment is intended to protect the customer from the contractor who is failing. The contractor who may who may fail to adequately complete its obligation under the contract. Like in the event of the contractor failing his obligation, the customer will be protected with this retention money. That's why he retained. Simple. Next, so it doesn't have any financing component. And next question, 34th is XYZ Limited. It is a personal computer manufacturer. Okay, it enters into a contract with the customer to provide a global PC support and the repair coverage for 3 years. It is giving PC support and repair coverage also for how many years? 3 years. That is right. Along with PC, he is giving this support and repair coverage. Now the customer purchases this support service at the time of buying the product. Now the consideration for the service is additional 3,000 for this consideration. See here, he is collecting completely for 3 years once only. That is 3,000. Now the customers electing to buy this service must pay upfront. That is, monthly option is not available. Here, as monthly option is not available, does this have any significant financing component? We can say no. Why? Because the customers, by electing this, by paying upfront, what the company XYZ will gain. XYZ will gain, like XYZ will be able to maximize its profitability as it's getting all the amount upfront. And here, if it is monthly payments, the customer may lose to renew. Customer, it is for the customer that it is less likely to be renewed by the customer. Means sometimes customer might forget to renew every month. If it is 3 months, we'll get the payment all at once only. And usage also in future years. Once we paid for 3 years, and we may not use so much for all the 3 years. So here the usage in the future years also may become smaller. And the last point is the administration costs also. So for every month renewal cost, we have to maintain a company have to maintain a department, and the company may have to pay them the salaries, like the person who is renewing it. So administrative costs also occur for the person to get renewed every month. They have to call and they have to ask for the renewal. So this is a big process. So the company XYZ Limited wants to avoid all this. That's why it entered into a 3 years That's why it is giving the support for 3 years all at once, and it's collecting 3,000 at once only. So here you can say this, there is no significant financing component because the reasons are other than the provision of finance. Here the reasons whatever by the company had entered into is the reasons other than the finance. So once, see, important points I've all covered. See, to determine whether there is a financing significant financing component in the contract or not, the entity considers the nature of the service, first nature being offered, and the purpose of the payment terms. Nature and the purpose. So the entity charges a single upfront payment, not with the primary purpose of obtaining a finance from the customer, but to maximize profitability. First intention is maximize profitability. Take into consideration the risks associated with the providing the service. Also, specifically, if the customers could pay monthly, they would be less likely to renew the they may not renew, and also the population also of the customers who continue to use the support services in future may be less, maybe smaller, and also less diverse. They may not use. Okay, and also the customers that choose to renew historically may also decrease drastically. So finally, you can say that the entity would incur more administration costs also. We discussed this point also, such as the cost that is related to administrative renewals and collection of monthly payments. You have to maintain staff. So in assessing whether or not this has a significant financing component, XYZ Limited determines that the payment terms are structured primarily for reasons other than the provision of service to the entity. So here XYZ Limited charges a single upfront payment only for the services because because other payment terms such as monthly payment terms would affect the nature of the risks it assumes to provide, and may make it uneconomical to provide this service to the customer. So it's like that. So there is no significant component in this contract. Next question: a computer hardware vendor is there. He entered into a contract, 3-year agreement with the customer. Okay, and the customers with lower credit ratings have to pay before only. Lower credit ratings have to pay the entire arrangement, entire money in advance only. Okay, of the provision, where the other customers may pay over time. So you can say how you can say whether it has a significant financing component or not. Actually, it is no. Why? The persons with low credit ratings may not pay. That's why to protect against the customer non-payment, this have been entered. So you have to write the same. That's why there is no significant financing component. This is to protect against the customer's non-payment. Next, 36 question is same. It's like the customer vendor enters into the software vendor here. Software vendor entered into a contract with the customer to provide license solely in the exchange of sales-based royalty. Means it's like okay, license will be exchanged for sales-based royalty. So license will be transferred now, and the sales-based loyalty is something which is a future event when the sales were made. Okay, this is not in the customers or the entity's control. So how many sales will be made, and the royalty that is based on the sales is a future event. It is a future event. So how the answer goes: although the payment will be made in areas, because of the total consideration varies because the total consideration varies based on the occurrence or non-occurrence of the future event that is not within the control of the entity, because the future event, that is the sales that is made in future, it is not in the control of the customer or the entity. It is not in the control of anyone. So here the software vendor concludes that the contract does not provide the customer or the entity with the significant benefit of financing. Next, 37 is like this: a EPC contractor enters into a 2-year contract. He enters into a 2-year contract to develop the customized machine for the customer. So here the contractor is developing a customized machine. So it's for the customer only. So here the contractor is concluding that the goods and services in this contract constitute a single performance obligation. So based on that, because it's customized, so based on the terms of the contract, the contractor determines that it transfers the control over time and recognizes the revenue based on the input method, because reflecting the transfer of the control to the customer. See, based on the terms of the contract, I might have gone wrong somewhere. Based on the terms of the contract, the customer determines that it transfers the customer what it is determining, it is transferring control over time, and it recognizes the revenue based on the input method. Based on which method? Input method. that best reflecting the transfer of control to the customer. Here the customer also agrees to provide the contractor monthly progress payments, with the final 25% payment, and this 25% payment is a holdback payment. Okay, that is due upon contract completion. So as a result of the holdback payment, there is a gap between when the control transfers and when the consideration is received, creating a financing component. So analyze whether there is any financing component in the contract or not. So that is like, it is like this: there is a gap between the payment when the contract transferred and when the consideration is received. So is there a financing component or not? So here 25%, whatever the holdback payment is there, this is to ensure the successful completion of the project. It is not a significant financing component. So same thing you have to write. There is no difference between the amount of principal, promised consideration, and cash selling price. So both are same. Promised consideration and cash selling price are same. There is no change. Okay, that the customer did not pay any premium on paying a portion of consideration in areas. Okay, this payment is just the holdback payment, whatever is there. This is to ensure the successful completion of the project. That's it. So you can say there is no financing component. Next, 38th question is like this: Company X is a developer and a manufacturer of a defense terms. Like company Z is a developer and manufacturer of a defense systems. Okay, this defense system is primarily a tier to supplier parts and integrated systems, like OEMs. It is supplying tier to suppliers and OEMs, integrated systems, to OEMs in commercial market. And means it's like original equipment manufacturers it is supplying to. Company Z is supplying to. So here company Z enters into a contract with company X for the development and the delivery of 5,000 highly technical specialized missiles, okay, for use in the company's X platforms. So what it is doing as a part of the contract, now company Z is supplying to OEMs, right, to OEMs. Then what the OEMs are doing, OEMs is submitting OEMs is submitting states like this: company Z is supplying missiles to OEMs, and OEMs is giving the cost of 100 crores. OEMs is giving the cost of 100 crores, also award fees. When he is giving award fees upon the successful completion of the development and the test fire of the missile within 16 months, if it is completing, then it is getting a award fees. Okay, of here award fees is also 100 crores. Okay, however, the 100 crore award fees is awarded upon the successful completion of the development and test fire of the missile. It should be completed within 16 months. So here this is an incentive to produce the high functioning missiles to company Z. This incentive is to produce high functioning missiles. So here the contract specifies that the company Z will earn up to 100 crore based on the company's X assessment of company assessment. I mean here company X is a um, I can say it is a original equipment manufacturer, right? It is a original equipment manufacturer. Yeah. Here also the contract specifies that Company Z will earn up to 100 crores. As it is a developer and manufacturer, it will earn up to 100 crores based on the company X assessment of this company Z's ability to develop and manufacture this missile that achieves the multiple factors, including it should achieve weight, velocity, and accuracy also. So partial award fees may be awarded based on predetermined scale. Partial may also be awarded. Here, assuming that total of assuming that the company Z is probable that it will get 80 crores. It will get out of 100 crores. It is estimating that 80 crore in the transaction price is related to the variable consideration. Okay, within India is 115. Now further, the entity has also concluded it should recognize the revenue over time for single performance obligation using the cost to cost input method or not. So analyze whether there is any significant financing component in the contract or not. You have to analyze. So in analyzing that, first step we need to do is company X. So whether the significant financing component is there or not, I can directly say it is no. Why it is no? Because the award fees, whatever is given, is a incentive to produce high functioning missiles to company Z, but out of that 80 is variable as per the contract, as per the estimate, as per the estimate that is made by company Z. So answer goes like this: company Z will transfer the control over time, beginning shortly after the contract is executed, but this company Z will not receive the cash consideration related to the award fee component. It will not receive from company X for more than 1 year in future. Hence, company Z should assess whether the award fees represents a significant financing component or not. Here, the intention of the parties in negotiating the award fee due upon the completion of the test fire and based on the results of that test fire was to provide the incentive to company Z. So here it is just giving an incentive. That's it. So there is no significant financing component. And the company Z also should not adjust the transaction price as per Ind AS 115. So here we are talking about practical expedient. An entity need not adjust. So here practical expedient says that an entity need not adjust the promised amount of consideration. Here it need not adjust any promised amount of consideration. Why? Because for the effect of significant financing component, if the entity expects that at the contract, at the beginning of the contract, at the contract inception, that the period between when the contract enters into the promised good or service, or or to the customer, and I mean like when the entity is entering into a promised good or service to the customer, and when the customer is paying for that promised good or service, I mean within the supply, transfer, and payment received. If that period is less than 1 year, then it need not adjust any significant financing component. Okay, that is a practical experience. Less than 1 year, you need not adjust anything. Next question 39. So H entered into a 2 year contract. It is 2 year. Okay, it entered into a company C. 2 year, and this is to develop a customized software to company C. And also H concludes that the goods and services in the contract will consider single performance obligation is based on the terms of the contract. Company H, what company H determined? Company H determined that it transfers the control over time and recognizes the revenue based on the input method, best reflecting the transfer of the control to company C. Here, company C also agrees to provide company H monthly progress payment. So, company C is giving monthly progress payments to H based on the expectation of the timings for the cost incurred. Company H concludes that this progress payments, whatever the company is making, I mean, whatever C is making to H, this progress payments are being made such that this timing between the transfer and payment is never expected to exceed 1 year. So you can definitely go ahead and apply the practical expedient. He is asking whether any significant financing component is there in the contract or not. Directly, no. You can apply practical expedient. Why? Because the time between the time gap here come in the last line. If you could see, the time gap is never expected to exceed 1 year. I mean the timing between the transfer of the control and the payment. So you can apply. Go ahead and apply this practical expedient. So company H concludes that it will not need to further assess whether a significant financing component is present and does not adjust the promised consideration in determining the transaction price, as they are applying a practical expedient. You can go ahead and say that you need not recognize. So what Ind AS 115 is saying, an entity shall present this effect of financing. Entity will present the effects of financing. That is, any effects, if they are effects. In this question, there are no effects, but if they are effects of financing, you have to present effects of financing separately as interest revenue and interest expense separately from the revenue, from the contract with the customers in the statement of P&L account. So here, interest revenue or interest expense should be recognized only to the extent of the contract asset, only to the extent that a contract asset or I mean, it may be a receivable or a contract liability is recognized in the accounting to the contract. Only to that extent, interest expense or revenue should be recognized. Next question number 40. In this, an entity enters into a contract for the sale of product A. So, entity is entering into a contract. It is selling product A for 1,000. Okay, for 1,000 rupees. So, as a part of that contract, what the customer entity is giving to the customer, entity is providing 40% discount voucher to the customer. And here, whatever is 40% is there, That is in addition to the 10% discount that is given on all sales. Okay. This 40% discount voucher is to for future purchases up to 1,000 rupees in the next 30 days. So you can use this voucher up to 30 days only. And this is intense. The company is also offering 10% discount for all sales for the next 30 days. A part of the seasonal promotion, it is also giving 10% general discount for everyone. Okay. Not only for the one who purchase product A, for everyone it is given. And you can say this 10% cannot be used in addition to 40%. Like it is not complete 50%, it is like 30 plus 10, 40% completely, like that. The entity believes that there is a 80% likelihood that the customer will redeem the voucher, and on an average a customer will purchase 500 rupees of the product. It is an assumption. So how you'll calculate, customer is purchasing 500 of the product, multiply, there is 80% likelihood, multiply with the discount of 30%, you'll get the discount voucher. That is 120. You have to recognize 120 with respect to this. You have to allocate. So the answer goes like this. Since all the customers will receive 10% discount in the next 30 days, the only additional discount is 30%. That is incremental discount, right? That is incremental discount, and the entity accounts for this promise. The entity accounts for the promise to provide the incremental discount as a separate performance obligation in the contract for the sale of product A. So here entity is also believing that entity believes that 80 there is 80% likelihood. So into 500 products into 30%, that is the standalone selling price. Entity is estimating the standalone selling price for the discount voucher to be 120. 500 into 80% into 30%. Here the standalone selling price of the product A should be adjusted to 1,000 rupees. That is, you have to see product A is 1,000 rupees. Discount voucher is 120. The total comes to 1,120. So here you have to allocate the transaction price in between. Like for the product A, you have to allocate take base of 1,000 and you have to use um, I mean 1,000 should be allocated between 1,000 and 120. Okay, it's like that. So the entity should allocate 890 to product A, also 110 to 110 as a discount voucher. Okay. Also for here when the customer redeems it, he it here 890 will be recognized as revenue. Will be recognized as a revenue when the product A is transferred. When the control is transferred to the customer, 890 will be recognized as a revenue. And here 110 is recognized as a revenue whenever the customer redeems that, or whenever it expires. When it is expiring, within 30 days. So within next 30 days, or whenever the customer redeems the goods or services, then this 110 will be recognized as a revenue. Next question, 41st. Here entity enters into a contract with the customer to sell product A, B, and C in exchange of 10,000. Same. This question is like you'll have a directly observable value. So it's like three products combinedly will be are sold at 10,000 rupees, and the entity also will satisfy the performance obligation for each of the products at different points in time. You can say it is different points in time, and the entity regularly sells this product A separately, and therefore here the entity is regularly selling product A separately, and therefore the standalone selling price is observable. You can easily observe that is 5,000. That is given below. And also this standalone selling price for B and C is not directly observable. You cannot observe it. B and C standalones are not observable, but together you can have. See, going forward, because the standalone selling price of B and C are not observable, the entity must estimate them. Now, what might be the selling price? The entity should estimate. In a whole 10,000, 5,000 is directly observable. What is left? 5,000. This 5,000 should be allocated between B and C. That is the case here. So this is our observation from the question. So in making those estimates, the entity maximizes the use of the observable inputs. So it goes like this: product A, B, and C. He gave 5,000 for A, which is directly observable, and B, C are not observable. That's why it is using adjusted market assessment approach for B, and expected cost plus margin approach for C. So what is the transaction price here? First, the entities here what the customer is doing. The customer is receiving a discount for purchasing all the three products, right? Well, the selling price is only when the selling price is 15,000, he is getting it all the three products at 10,000 only directly. The entity also considers that there is no observable evidence about the performance obligation to which the entire discount belongs. Yes, there is a, see, here he said for product A, 5,000 is directly observable. That is clear for us. And for B and C, it is not observable. But we don't know how the discount should be allocated. How the discount should be allocated. Whether it should be allocated for B and C, there is no direct evidence for that. So what we'll do, the discount is allocated based on relative, um, it is based on a proportionately. Okay, it is allocated proportionately across A, B, and C, and and the discount, and therefore the transaction price will be allocated like this, like proportionately. You will take the base and you will allocate it. And in the same way, the next question is also given. In this also, YZ together will be 50. So when the YZ together is 50, there you will allocate the discount. Whatever the discount is there, you'll allocate to Y and Z. In this previous problem, so first when I said the 5,000 should be, allocated to this both is wrong. Why? Because only 5,000 for product A is directly observable, and B and C are not directly observable. Neither you don't know whether these two B and C will be, you know, there is no direct evidence whether this B and C will be sold in package. They are not sold together. Also, they are not sold together. There is no direct evidence that they are sold together. So in this question, you can see that product X, Y, and Z are there. X is 50,000 and Y and Z will be together sold at 50,000. In the same way, in the before problem, we don't know that B and C will be together sold at 5,000. That's why we are allocating the discount for all the three products proportionately. Here in the first case, the entity enters into a contract with the customer to sell X, Y, and Z. Okay, for 1 lakh only. Means 1,20,000 product X, Y, and Z will be sold for 1 lakh. There is a discount of 20,000. You can say that also product X, the entity enter into a contract with the customer to sell X, Y, and Z for 1 lakh, and the entity will satisfy the performance obligation of each of the products at different points in time, or X, Y, Z at the same point in time. You can sell three products separately, or X, Y, Z together. You can sell at the same point. Now here determine the allocation of the transaction price to Y, and Z. How we have to allocate the transaction price to Y and Z. So there is a discount of 20,000 in the contract. We know that. So here the contract includes a discount of 20,000 on the overall transaction, which would be allowed proportionately to all the three performance obligations when allocating the transaction price using the standalone selling price method. That is, you are allocating discount based on this standalone selling price method. Okay. However, because the entity regularly sells X, Y, and Z, together for 50,000, product X, Y and Z together for 50,000, product X can be sold for 50,000. It is a evidence. It has evidence that the entire discount will be allocated to Y and Z only. Okay, allocated to Y and Z only. Also, if the entity enters into a contract, here in the question he asked us two things. What did he ask us? Here he said the entity will satisfy the performance obligation of each of the products at different points in time. You have to allocate the discount if it satisfies a different point in time. That is the first condition. Then second condition is if it three products separately at a different point in time, or second condition is product Y and Z at the same point in time. That they like that there are two conditions. So first condition, if the entity transfers the control of Y and Z at the same point in time, and next the entity requires the entity to transfer, if the contract requires the entity to transfer Y and Z at a different point in time. So when it is at the same point in time, the entity could, as a practical expedient, account for the transfer of those products as a single performance obligation. That is, the entity could allocate the 50,000 of the transaction price to the single performance obligation. 50,000 will be allocated to a single performance obligation, and he will recognize 50,000 when the products Y and Z are simultaneously transferred to the customer. In the second scenario, if the contract requires the transfer of control at different points in time, you need not allocate it between Y and Z. When Y and Z are sold together, are transferred together at the same point in time. But here Y and Z are transferred in the third scenario. Here in the second scenario, Y and Z are transferred at a different point in time, so that here you have to allocate the discount of 20,000 to Y and Z. Okay, and that way you keep on allocating here. Now the second case is residual approach. Residual approach. Now whole contract amount is 1,30,000. In this whole contract amount is 1,30,000, and you can say the same amount before that you have seen here, 50,000, and this Y and Z are together 50,000, and you have remaining 30,000 here, that is alpha, product alpha, and that product alpha is ranging between 15,000 to 45,000. So here 30,000 can be allocated to 15 and 45,000, right? So that's what is given in the answer. So before estimating that, this is residual approach, you're using residual approach here, and before estimating the standalone selling price of the product alpha, you have to determine whether any discount to be allocated to other performance obligations or not. Yes, in case A, how you did, in case A, because the entity regularly sells products Y and Z together for 50,000 and product X for 50,000, same you will use here. It is observable evidence that 1 lakh should be allocated for all the three products, and now 30,000 is left. You can allocate it to alpha, Ramsey. Now, case C is same thing, but here whole transaction price is only 1 lakh 5,000 instead of 1 lakh 30,000. So here it is only 1 lakh 5,000 instead of 1 lakh 50,000. The same fact as in case B apply to case C also, except the transaction price is 1 lakh 5,000 instead of 1 lakh 30,000. Here consequently the application of the residual approach would result in the standalone selling price of 5,000 for alpha, for product alpha. So here product alpha is ranging between 15,000 to, as we have read before, it is ranging between 15,000 to 45,000. But here there is only 5,000 left to allocate to alpha. So here the consideration, here the entity concludes that the 5,000 is not, will not faithfully depict the amount of consideration to which the entity expects to be entitled in exchange for satisfying its performance obligation to transfer the product alpha, because this 5,000 does not approximate the standalone selling price of product alpha, which ranges between 15,000 and 45,000. So consequently the entity reviews its observable data, including the sales, and it is reviewing its observable data including sales and margin reports. It have to review, and to estimate the standalone selling price of product alpha, you have to use another suitable method. Okay, that is not given here. You have to use another suitable method as per your entity's terms. So here the entity allocates that the transaction price is 1 lakh 5,000 to it have to be it will allocate based on using same relative standalone basis, but it have to review its observable data, and it have to estimate the standalone selling price that should be allocated to alpha. Next question 43, we'll do till question 45 questions we'll do. Okay, so here the 43rd question is like, entity enters into a contract, okay, with the customer, with the customer for two intellectual properties, that is license A and license B. Okay, license A is for 16 lakhs and license B is for 2 million 20 lakhs. Okay, now going forward, the entity is transferring the license A at inception. The entity is transferring license B at inception. B will be transferred at the very beginning, and the A will be transferred 1 month later. So here the first case is variable consideration allocated entirely to one performance obligation. If the variable consideration is allocated entirely to one performance obligation, the price that is stated in the contract for license A is a fixed amount of 16 lakhs, and license B, and for license B the consideration is only 3% of the customer's future sales of products that use license B. So here for the purpose of allocation, the entity estimates its sales based royalties. Entity estimates its sales based royalty to be 20 lakhs. Now allocate the transaction price. Okay, simple. In the first case, the price, license A price is 16 lakhs. Okay, and the license B price is 3% of the future sales. No matter, you don't know how much the future sales will be. Okay, but it is 3 lakhs of the future sales, but license B price is 20 lakhs. You know that, and license B will be transferred at the contract inception only. Now we have to allocate the transaction price. So to allocate the transaction price, here first the entity considers the index 115 and concludes that is revenue from contracts with customers, there is some criteria to be considered. Okay, and it concludes that the variable consideration should be allocated entirely. It concludes that the variable consideration should be allocated entirely to license B at the beginning. What is a variable consideration? P% of the future sales. That is only variable here. Okay, that should be allocated entirely to B only from the contract inception. So here the entity contract concludes that the criteria are met for the following reasons. First reason is there is a variable payment. The variable payment is relating specifically to the outcome of a performance obligation to transfer license B only. So here variable payment is for only license B, and second, the expected royalty, whatever the 20 lakhs expected royalty is there, okay, that is entirely allocated to. See here in question he gave you that for the license B, T% of the customer future sales, and that T% of the customer future sales will be 20 lakhs. So this 20 lakhs is, matching with the 20 lakhs price, license B price. So that's what he's saying. Yeah, it's here. Here the allocating the expected royalty amounts to 20 lakhs entirely to license B only. You can allocate. Why? It is consistent also. It is consistent to allocate with the allocation objective that is given in Ind AS 115. Why? This is because the entity's estimate of the amount of the sales based royalty, that is 20 lakhs, approximate the standalone selling price of license B, and fixed amount of 16 lakhs approximate the standalone selling price of license A. Here the entity allocates the 16 lakhs to license A. This is because based on the assessment of the facts and circumstances related to both licenses, allocating to license B, some of the fixed consideration in addition to all the variable consideration would not meet the allocation objective under Ind AS 115. So here the entity transfers license B at inception itself of the contract and transfers license A 1 month later. When he transferring license A 1 month later. So upon the transfer of license B, the entity does not recognize the revenue. The entity is not recognizing the revenue. Why? Because for license B, the entity does not recognize the revenue because the consideration that is allocated to license B is in the form of sales based royalty, right? Therefore, the entity recognizes the revenue for this sales based royalty when those subsequent sales occur. Sales is a future event, you don't know. It is 3% of the sales, and the estimating. entity is just estimating that the sales based royalty might be 2 lakhs, 20 lakhs. It is estimating. So they have not yet occurred. So at contract inception, it won't be recognized. Will not recognize because it is sales based royalty and it's a future uncertain event. So, but after 1 month, whenever the license is transferred, 16 lakhs entirely will be allocated to license pay only. Next, case B is variable consideration is allocated on the basis of standalone selling prices. That is standalone selling prices. Variable consideration is allocated. Here the variable, see the question goes like this. Entity A is fixed at only license A is fixed at only 6 lakhs, and license B is 5% of the customer sales, right? It is 5% of the customer sales, and before 3% of the customers future sales is 20 lakhs, that is estimated in case A. Here 5% of the future sales is estimated to be 30 lakhs. Okay, 30 lakhs where entity A is transferred, here license A is transferred 3 months later. Here in the first scenario, license B is transferred at inception and A is transferred 1 month later. Here license A is transferred 3 months later, right? Now the royalty due to the customer, the royalty that is due from the customers first month of the sale is only 4 lakhs. We realize the royalty of a first month sales happened, and that 5% of that sales is 4 lakhs. 5% of that sale is 4 lakhs. Now allocate the transaction price and determine the revenue to be recognized. So I can say, without going to the question, let's analyze this. First, you can say that the entity standalone selling prices is not reflecting the selling prices. I mean, for example, entity A is having 6 lakhs. Entity A is having 6 lakhs price fixed amount, and entity B is having 30 lakhs, and this 30 lakhs is 5% of future sales, right? So whenever you receive 4 lakhs from the first month sale, you will allocate based on the standalone selling prices that you already know. That is this 4 lakhs, whatever is recognized, it will be allocated in the ratio of 16 lakhs and 20 lakhs. It will be allocated in the ratio of 16 lakhs and 20 lakhs because they are the standalone selling prices. But here, whatever the prices are fixed, like 6 lakhs plus 30 lakhs, 6 lakhs plus 30 lakhs are again 36 lakhs only. But here, the allocation is not as per the standalone license price. So that's what you have to explain him as per Ind AS 115 clearly. The answer goes like this. So, yeah, 1 second. So the normal case B says, as per given answer, to allocate the transaction price, the entity is applying Ind AS 115 revenue from contact with customers to determine whether to allocate the variable cost, whether to allocate this variable consideration, that is sales based royalties, entirely to license B or not. So whether to allocate the variable consideration, what is variable consideration here? Sales based royalties. Whether to allocate the sales based royalty entirely to license B or not, you have to first determine, because that the answer is completely no. In applying that criteria, the entity is concluding that even though the variable payments relate specifically to the outcome from a performance obligation to transfer license B, but here the customer subsequent sales of products that use license B, okay, this the allocating of this variable consideration entirely to license B would be inconsistent. It is inconsistent with the principle for allocating the transaction price. It is inconsistent with the principle for allocating the transaction price. So here allocating 6 lakhs to license A and 30 lakhs to license B, it is not reflecting the reasonable allocation of the transaction price because the standalone selling prices of A and B are license A is 16 lakhs and license B is 20 lakhs. So consequently, the entity applies a general allocation requirement. It will use relative, it will use that we have studied before, relative allocation approach, like general allocation requirement only. So the entity allocates the transaction price of 6 lakhs. First, 6 lakhs will be allocated between 16 lakhs and 20 lakhs. First, license A, whenever the license is transferred, then license A will be allocated between 16 lakhs and 20 lakhs respectively. And the entity also allocates the consideration that is related to the sales based royalty as on a relative standalone selling price basis. However, when the entity licenses this intellectual property in which the consideration is in the form of, but when it is licensing the intellectual property, this is not, this is completely different from the question. This is not license A or B. He's saying, see, what I told before is the entity allocates the consideration raised to standalone royalty on relative standalone basis. Just now I told on relative standalone basis it will do. However, when the entity licenses, but when entity is licensing intellectual property, not A, not B, it is completely different. Intellectual property, then in which consideration is in the form of sales-based royalty, then the entity cannot recognize revenue until later of the events occur. What are the events? Subsequent sales occur or performance obligation is satisfied. Either of the two occurred, whichever is later, then revenue will be recognized. For what? Intellectual property. Here, license B is transferred to the customer at the inception itself, and 3 months later, in the second scenario, second case, here license B will be transferred. Whenever the license B is transferred, the entity recognizes revenue. So, for the first, when you receive 6 lakhs, even then you will allocate between A and B. Okay, in the ratio of 20 lakhs for B and 16 lakhs for A. Okay, in the ratio of 20 lakhs for B and 16 lakhs for A, you'll get 3 lakh. 3,33,333 if when you're allocating 6 lakhs, you'll allocate. Next, in the first month when you're receiving 4 lakhs, this is when A is transferred. Okay, when in the first month when you're receiving 4 lakhs, then 4 lakhs will be allocated between 20 lakhs for B and 16 lakhs for A. So this is because although the subsequent sale by the entities, customers occurred, the performance obligation to which the royalty has been allocated has not been satisfied. Performance obligation is not satisfied for which the royalty has been allocated. Next question 44. Here on 1st April, consultant enters into an agreement for 3 services. First one is due diligence, valuation, and software implementation. So here for due diligence, three services, software implementation services, three together are for 2 crores. Three together are for 2 crores. Now entity can earn bonus also. Bonus is 20 lakhs. When he'll earn bonus, it is only depend on the software implementation only. If it completes the software implementation by 30 September, then it is earning a bonus of 20 lakhs. That is 1 crore for software implementation, 1 crore plus the bonus of 20 lakhs for software implementation. If it completes by 30 September, if it completes by 31st December, then it will earn 10 lakhs bonus. That is 10 lakhs bonus plus whatever 1 crore is there. So 1 crore plus 10 lakhs. But here the uh, due diligence valuation and software implementation are given here. At the contract inception itself, the contractor, the consultant, here the consultant is believing that it will complete, definitely the software implementation will be completed by 30 September, 30 January 2011. 30 January, that is after 31st December. So first he thought he'll get the discount bonus of 10 lakhs. He thought, okay. And why he thought that? Because the consultant cannot conclude a significant reversal in the cumulative amount of revenue recognized will not occur when the indemnity is resolved. So this is one case. After some days, on 1st July, again when he is assessing, he thought, yes, now I can complete it by 30 September only. I assessed it wrongly. Now I can easily complete it by 30 September. Now he will he is estimating the transaction price of the bonus to be 20 lakhs. So here after reviewing its progress as of that July 1st, the consultant determined that he will that it is 100% complete, 100 per, that it is 100% complete in satisfying the due diligence and valuation. First two, it is 100% in satisfying this due diligence and valuation, 100%, 100%. But the software implementation, whatever is that, this will be only 60% complete by the end. Okay, as on 1st July, whenever it is assessing, it's thought like that. So how you will determine the transaction price? Here the transaction price is first. He will recognize 80 lakhs and 20 lakhs completely 100%, that is 1 crore. And here 1 crore plus 20%, 20 lakhs. 1 crore plus 20 lakhs will be 1.2 crore into 60%. That will be 72 lakhs. So here 1 crore will be recognized plus 72 lakhs will be recognized. So whole together, what will be the contractual liability? That is 1 crore plus 72 lakhs. See, the answer goes like this. Entity allocates the bonus of 20 lakhs, right? Now the total consideration is 1.2 for the software implementation only. I'm talking about only software implementation. And he is adjusting the cumulative revenue to date for the software implementation. That is 1.2 into 60%, that is 72. Right? Clear. Next, 45th. So for this video, this will be the last one. We did 15 questions today. Minitic Limited in this video. Minitic Limited is a payroll processing service. Minitic is a payroll processing service. Okay, Minitic is entering into a contract to provide monthly payroll processing services to ABC Limited for 1 year. It is providing monthly services. Determine how the entity will recognize the revenue. Payroll processing is a single performance obligation. On monthly basis, Minitic Limited is carrying out the payroll processing. Now, first, there are two things for payroll processing. What are the two criteria that is to be satisfied? First, the customer, Minitech Limited is a payroll processing company, and here the customer is ABC Limited. Here the customer ABC Limited is simultaneously receiving and consuming the benefit. The first criteria is you should simultaneously consume the benefit as and when it is received. And second one is the entity should not have reperformed the contract, need not reperform the contract for the services that have expired. So that is the second criteria. That the entity, here the entity is Minitech Limited. Minitech, when the Minitech Limited has terminated its contract, when the Minitech Limited has terminated its contract, when the new contract is taking up this payroll services, that new entity, whichever is taking up the contract of this payroll processing for the company of ABC Limited, it need not reperform the services that for the expired months for which Minitech Limited have already performed the payroll service. So that is the two criteria. So therefore, it satisfies the two criteria because already Minitech has done the payroll services. This new entity, whichever is appointed, if the Minitech Limited has terminated its service agreement, okay, before maturity, then it need not reperform the contract. That's why two are satisfied, two conditions are satisfied. That is, the services will be completed on monthly basis, are consumed by the entity at the same time whenever the service is provided, and also the revenue will be recognized over a point of time. So here, as the two criteria are satisfied, the revenue will be recognized over a period of time, over the period of time. Here, the for the certain performance obligations, an entity may not be able to readily identify whether a customer simultaneously receives and consumes obligation is whether here in certain performance obligations, not in this, in certain performance obligations, an entity may not be able to identify readily. He is not able to identify. An entity may not identify whether a customer simultaneously receives the benefits or not. So what you have to do in such cases? In such cases, a performance obligation is satisfied over time. You can say that yes, performance obligation is satisfied over time if the entity determines that if the entity determines that okay, the another entity would not need to substantially reperform the work that the entity has completed to date. If that other entity if that other entity will need to uh, that other entity were to fulfill the remaining performance obligation to the customer. See, this is very simple. Performance obligation is satisfied over time if another entity, whatever the new entity is appointed, once Minitek left, the other entity need not would not need to substantially reperform. It need not reperform the contract. It need not reperform the work that the entity has already been completed. Here, entity is Minitech Limited. That the Minitech Limited has already completed, new entity need not do. If the other entity were to fulfill the remaining performance obligation to the customer. So, whenever this certain performance obligations are not readily identifiable, then you have to check whether the other entity had to reperform the contract or not. If need not reperform the contract and it is doing only from that contract where the old entity left, so then you can say that the obligation will be satisfied over time. So in making such determination, the entity will make two assumptions. First assumption is disregard of the potential restrictions or practical limitations, disregard with anything of that would otherwise prevent the entity from transferring the remaining performance obligation to the another entity. And second one is presume that the another entity fulfilling the remainder of that performance obligation would have the benefit of they will not have sorry they would not have the benefit of no WIP benefit. So what is the first assumption? You can transfer the remaining. You should be able to transfer the remaining uh, performance obligation to another entity. You should be able to transfer the remaining performance obligation to another entity provided there are no contractual restrictions or practical limitations. Okay, provided disregard with all these contractual restrictions, you should be able to transfer. And also the second entity who is performing that remaining performance obligation should not have a benefit of work in progress. So these are the two assumptions that is to be satisfied. Okay, two assumptions that you have made in uh, saying that the performance have been satisfied over time. Okay, performance obligation is satisfied over time. So all that it is. So stay tuned for the remaining. I'll be uploading today itself.